Let's get started. Government has reiterated the local content strategy, which is focused on local procurement of goods and services. This is said to be government's bid to grow local industry. This was expressed at a post-cabinet media briefing by the Minister for Information and Publicity, Honorable Monica Mchangwa. We have footage from the post-cabinet briefing. Let's have a look.
Strategy, which was again presented by the Minister of Industry and Commerce. The Zimbabwe local content strategy, which is a component of the country's industrialization policy, aims to promote local value addition and linkages through the utilization of domestic resources. The critical strategic actions will include preferential local procurement, capacitation of local suppliers, and capacitating research and development institutions, and also establishment of plans for the transfer of technological know-how. More specifically, the Zimbabwe local content strategy will help to increase local content levels in prioritized sectors from the current levels of approximately 25% to around 80% by 2023. It also intends to increase capacity utilization in prioritized sectors from the current levels of approximately 40% to around 75% by 2023, and also to increase manufactured exports in prioritized sectors by 5% per annum.
Minister Mchangwa also added that government has approved for the establishment of 4 gold centers across the country. So this is actually a bid by government to increase deliveries to fidelity printers. Let's have a look.
For the establishment of 4 gold centers under as presented by the Minister of Mines and Mining Development, the gold service centers will be established as follows: 1 in Silobela, that is in Midlands, another one in Mount Darwin, Mashonaland Central, and then another in Shamfa, Mashonaland Central, and another in Penalonga in Manicaland. The centers will be operational by 1st October 2019. Fidelity printers and refineries will provide the initial capital for the establishment of these gold buying centers, and also they will fund the capacitation of miners supplying the gold centers. This should result in the application of better mining methods and increased recoveries. This development will result in gold centers being brought closer to the gold miners, thus facilitating increases in gold deliveries to the fidelity printers and refineries.
Now, a quarterly report released by Treasury shows that Zimbabwe is left by 4 months of supply of grain. The report shows the grain stocks of GMB stood at 876,000 tons at the end of March 2018, comprising 776,000 tons of maize and 100,000 tons of small grains. The shortage is attributed to the failure of the 2018 and 2019 agricultural season, which resulted in a poor harvest. Now let's get into the stats to look at what that report actually reveals. So this would be the presentation of the figures. At the top there is the total grain that we have, which is reflected here by the figures at the bottom. So moving from $126 US dollars per ton to 1,400 US dollars per ton. This was expressed again by the Minister Mchangwa at the post-cabinet briefing this afternoon. Let's have a look.
Considered and approved that the GMB maize producer price of 242 US dollars per metric ton be payable into farmers RTGS dollars based on the prevailing foreign currency interbank market rate. In this case, therefore, the maize producer floor price is thus reviewed upwards from the current 726 RTGS dollars to RTGS dollars 1,400 per metric ton based on the interbank market rate of US 1:5.5. The review of the maize producer price does not translate into an upward adjustment in the retail price of milling, since the GMB will continue to sell maize to millers at a government subsidized rate. Cabinet is appealing to business people not to increase prices, as the GMB buying price has no impact on the selling price of milling.
But then again, this would have an effect in terms of our inflation. Coming from an inflation in the previous month at 66.8%, moving right up to 75%, with a revision of the producer price for maize, we could actually see an upward trajectory with regards to our inflation. The IMF has projected an inflation in the last month of the year to stand at 40%. As we make progress, the World Bank has revised downwards its GDP projections for Zimbabwe. The World Bank had projected a GDP growth of 3.6%, but according to its most recent update, it projects a GDP decline of 3.2%. This would essentially spell out a recession. Now, to get into the stats of what it is that we're talking about here, you'd find that for the 2019, which is this column over here, this is 2018 and that is 2019. IMF had projected a GDP slump of 5.2%. Meanwhile, World Bank had projected 3.8%, but now they have actually made a downward revision to a negative 3.2%. While government insists on 3.1% in the positive, as well as the African Development Bank in the positive at 4.2%, it remains to be seen who turns out to be the better prophet. Equity Access projects again a GDP decline of negative 3.8%. It remains to be seen how the story actually develops. Meanwhile, Hippo parent Tongaat Hullet has been suspended from the Johannesburg as well as the London Stock Exchanges for failing to publish 2018 financials. Last month, Tongaat hinted on a review of their financials, which would result in a hit-up of about $300 million. Tongaat Hullet has operations in Zimbabwe, Mozambique, as well as South Africa. In Zimbabwe, Tongaat has ownership of Hippo Valley and holds a 50% stake in Triangle Estates. This now would be the performance of the Zimbabwean unit, which is actually Hippo. And now you look at the historical performance from 2014 moving up to 2018, you'd find at the top there would be the revenue performance, moving at the bottom, which would be their profit after tax position. 2016 revenue of 116 million United States dollars against a loss of $8.8 million. Revenue scaling in 2017, $148 million, slumping in 2018 to $137 million in revenue. However, their profit position has improved from 2016, where they recorded a loss, moving right up to $11 million in profit after tax. This concludes our evening news bulletin. Up next is a news review. Please stay tuned. Welcome back, viewers. It's now time for news review, and with me to discuss the news that we just reported is economist Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Good evening, Eben. How are you today?
Won't complain. You don't get better yourself.
I'm very well.
Beautiful. Now let's get into the nitty-gritties of the news. Interesting developments, quite a good number of them. Now let's start with bread and butter issues. According to a report issued in the Treasury, it shows that we've got just 4 months of grain supplies for the year. What is your perspective where that is concerned?
If you look at the developments, especially in the 2018-19 farming season, we actually had a serious adverse farming season. So in terms of maize production, production was actually grossly affected, and the country projects a harvest of only 700,000 tons compared to demand of 2 million tons per annum if we include both human and animal consumption. So what we are seeing is it's a country that had relying with stocks that we accumulated from the 2016-17 farming season and the 2017 and 18 farming season. This past season we didn't happen to harvest much. But what actually this entails is there is actually more pressure in terms of import requirements to meet this gap.
I realize. Now let's talk about the most recent development where Minister Mchangwa says, according to their cabinet seating, there's actually been a revision in terms of the producer price for maize from 726 RTGS dollars to 1.4.
Prices as well, they've been actually a disincentive for farmers, especially when they want to sell their much treasured crop. If you look at what's happening in the country in terms of price dynamics and inflation, whoever holds a certain commodity is king. So there is no one who wants to sell his maize or whatever commodity that he thinks would have a better price going into the future. So maize is actually one of them. So this review price where they are now setting the price charging in US dollars, then they will convert it in RTGS dollars. I think it's a way to incentivize farmers to deliver what they actually harvested, to deliver it to GMB, such that they would supply to those deficit prone regions in the country. There are some areas like some parts of Uganda, Gokwe, to mention but a few, where that UN agency reported that they are in dire situation in terms of the food security situation. Right. So I think it's actually pressure as well to the government that it has to act and supply those areas with maize. But I think
now, just to come in there, what then would be the effect in terms of inflation? I mean, this would be the inflation graph of where Zimbabwe is actually coming from, right, moving right up to where we are now. We have got inflation that came in, most recent inflation figures at 76% against the prior month performance of 66%. What then would be the effect in terms of inflation for the country?
If you look at the Honorable's minister's statement, I think what's lacking there is the percentage of subsidy that they are giving to millers. They just said we'll give a millers a certain subsidy, and they didn't mention the level of that subsidy. So I think they are just trying to manage, because obviously when you raise prices, the producer prices, inflation it tends to go up. So I think in a certain way they are trying to manage those inflationary expectations. But I think if the government manage to have sufficient funds and to offer those millers a certain good subsidy, I think it might help in the short term to keep prices low. But obviously it's not sustainable, and I think going forward we will see inflation creeping upwards, actually beyond our own internal projections of above 83%.
I realize now the World Bank comes in and says, look, we're actually going to see a GDP decline of 3.2%, a revision from what they'd said. They'd projected a growth of 3.8%. But can you explain the difference in terms of the projections? Are we likely to see government follow suit because government upholds the 3.1%? I was speaking to the Deputy RBZ governor just a couple of weeks back, and they upheld their projections at 3.1%.
The World Bank's projections, I think they're now coming at a time when they are now revising their growth projections for the overall all the countries in the world. But if you look at what was happening, especially in our country, the earlier projections by the World Bank, they did it sometime, I think, in April, when they hadn't assessed the impact of this adverse weather, that adverse farming season, and as well as the impact of Cyclone Idai. So if you look at what they are saying, the World Bank is an increase in inflation, as well as depressed productivity in the agriculture sector, that has forced them to revise downwards their growth projections from the previously 3.6% to now negative 3.2%. I think they are now negative 3.2% and negative 5.2% by the IMF, and ours at negative 3.1%. I think we are speaking. We are all speaking. The same that 2019 is not a good year for Zimbabwe and all the sectors in the economy. I think we are projecting negative growth in all sectors of the economy. If you look at even the mining sector, which has been recently driving growth of our GDP, it is also being grossly affected by these monetary issues and high inflation as well. The increased cost of doing business as a result of early injection or early injection, yes, of a sovereign currency in the form of RTGS dollar, as well as those continued statements by those in positions of authority that the country will have its own currency by year end. That will actually dampen expectations and confidence in the economy, and as such it adds on to depress the investment, as well as feeding into this depressed economic growth. I'm not surprised to see a country suffering from a recession, because that's what happens when you implement austerity measures and you don't have a clear poverty alleviation plan, as well as a clear strategy on how you cushion your productivity sectors. That's what actually happens. Wherever I have seen, in terms of my studies that I've done before, I have never seen any country that has actually implemented austerity measures and had a good economic health position. Most of them, they suffered a recession, and most of them, they actually dampened those austerity measures quickly than they thought.
But Eddie Cross seems to suggest that we're on the right track, and even is actually rubber stamping the idea of a new currency.
If you look at how economists sometimes view what's happening in the development, I don't know where his optimism is coming from, but looking at what's happening on the ground, I'm not seeing us on a sustainable path. I'm actually seeing the finance minister actually early dampening the austerity measures, maybe trying to implement more economic stimulus packages that will drive the country out of the recession. If we continue implementing those austerity measures, they'll end up hitting the few surviving industries, and even the tax base at the balance. I think it will come down, and the country will struggle even to meet its revenue targets.
Well, thank you, Tinashe, for the perspectives. This is I was with economist Tinashe Kaduo. Thank you, viewers, for watching. Up next is a look at the stock markets. Please stay tuned. Welcome back, viewers. It's now time for Markets Daily, and with me is investment analyst Anesu Chimbumo. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Fantastic, and you?
I'm all right.
Beautiful. Please take it away.
All right. For the market today, it is all green for all four indices on the stock exchange. All share index is up 1.01%. Industrials index has added 0.98%. Mining is very bullish, still on a run, adding 2.44% for it to set at 248.51 points. Top 10 index has come out of a four-day run of losses, adding 1.41% for it to come back into the green on a week-to-date basis. For it after having settled at 184.01 points. Now, for that index there, we had 7 counters that were in the positive and 3 that were pretty much stable. Your usual would be Nat Foods hasn't made much movements. It is still settled at 0% at 703 cents there. Padenga very bullish, adding 5.29%. Old Mutual 4.38% after having let up some of its gains in the prior sessions. Inscore, Cassava, Delta, and Econet all did add about 2.48, 1.41, and 0.98 and 0.64% on a day-on-day basis. Now we are still looking forward to having a look at how Econet and Cassava have performed in the past financial year. There was some sort of profit taking that was happening in the past couple of sessions since the close of last week. I suppose investors have come to a place where they are reinvesting some of the profits that they did make out of investing in such counters there. Padenga still has that issue that is still pending, which has to do with them getting into and actually acquiring a new business that they say is export oriented as well. When they did hold their AGM, they did mention that that deal had a couple of I's to be dotted and a couple of commas to be put into perspective for them to continue on that deal. 5-day trends, all share index is now up 0.76%, while the mining's index is now at a very bullish 8.35%. Top 10 index is only up 0.11%, mainly due to the run of losses that it did experience in the last 4 sessions. Now, industrials index is up 0.63%. Now, the 0.76% that we saw on the all-share index pretty much explains how we have had a very mid-tire to low-tire influenced movement where the upward pressure has been coming from. I mean, if we look at our rises, for the top 3 rises there, we have mid-tire and low-tire stocks. Bindura being one of the mid-tire, they're coming up 7.32% to 11 cents, while the head of about 16 bulls today was Truett's, which added 16.86% for it to set at 2.01 cents, while General Beltings is at 2 cents after having added about 11.11% to its prior session share price. Dairy Board did add 5.47%. We've already touched on Padenga there. CBZ, a banking stock, has been performing very well in this past year, coming from as low as about 10 cents there. It is now trading at 45 cents. I suppose there should be some profit-taking behavior happening therefore for that stock. Simbisa letting up 0.87%, while OK settled at 50 cents after having come off 0.1%. Now, OK did mention that they did have a very successful year in quotes, I would say, because they did enjoy a very inflationary positive revenue line going up there, but then their volumes only did add about 1.1% to on prior year performance. So it would translate to a very much depressed demand, and only a very much inflationary induced growth in terms of their revenues. So we wouldn't be expecting much going into this financial year. So I wouldn't expect much from their earnings by the end of the year. because of how demand is very much depressed and how their sales mix may end up shifting towards to a more basic more basic mix. Now our forex market, if we have a look at the old mutual implied rate today, the old mutual stock on the ZSE also went up, just as the local bourse stock. So that also then caused for a weakening for that implied rate to about 9.3, while the parallel market is still very much stable at around about 8.5. For it still at 8.55 by close of day today. Some traders have been trading around about 8.65, 8.7, some still as low as 8.4. So that would be an average there. But interbank rate has continued to weaken. It would be a very positive thing for farmers now, since that there is a pegging that is supposed to be happening for their producer prices.
Well, thank you, Anissa, for the perspectives. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and visit our website, www.equityaccess.net. Thank you for watching, and good evening.
What's that feedback? Or is it because this is the one?